Now we turn to Asia, and we want to look and start with Asian PMIs, because one of the things that we were saying in June was that we were, as we got into June and then into July, we saw a lot of slowdowns picking up. And some of it was COVID related, don't get me wrong, but there was also other pieces to that. And what I mean by other pieces to it was looking at trade, looking at the general movement within the market. You started to see some of these underlying headwinds. So when we look at India, obviously July, when you look at July PMI versus June PMI, you had that recovery. But when you start looking at June versus July for South Korea, China, Thailand, Vietnam, Indonesia, you're starting to get some of these pressure points, Malaysia. So you have Australia, which was a little bit worse, but that is actually going to get a bit... it's going to deteriorate a bit more with some of the extensions of their lockdowns. But India is the one that had a nice pop. And the question, one thing that we've seen with China, with India, is that you get this resurgence because, okay, well, I'm no longer in some sort of provincial lockdown. You go back and then it starts to moderate. So we expect that to pull back. But then when you look at South Korea slowing, but China is the one, that continues to see some of this moderation, which is a concern when you think about the second largest economy continuing to slow down. And as a joke for Chinese data, if they're announcing something that's missing estimates, how bad is it really? Which is why we look at the underlying data sets and the local data to try to give you some color on that. But then a lot of the other regions like Thailand, Vietnam, Indonesia, Malaysia continue to struggle. And with the slow rollout of COVID vaccines, with the pressure that continues on the local consumer, that's not something we expect to see too much of an adjustment for over the near term. So now let's turn to India. So when you look at how India recovered, because remember the previous one is looking at manufacturing. So this is Asia PMIs for the manufacturing side, but when you look at India, it's a bit more complex than that. So 8 infrastructure industries was up 8.9%, previously was up 16.8%. But let's look at manufacturing. So manufacturing was at 55.3. So we saw that big resurgence, but services, now given it was from 41.2, came to 45.4, contracting still. And that's where the services side is where we think there's going to be some of that residual slowdown, where the PMI composite was still contracting, was expected at 43.1, came in at 49.2. So I'm sorry, prior was 43.1, came in at 49.2. So you got some of that growth, but you're just not getting to that level that you really need to be at. So now let's look at South Korea. So South Korea business survey for August came down a bit, was at 99, now at 92. Non-manufacturing survey was at 82, now 78. So you're looking forward. So August is looking a little bit softer, but then the industrial production year over year for June, expected 9.6, came in 11.9, which was expected based on what we saw with imports, exports. Now, when we look forward, exports, imports are softening a bit, and still elevated, still strong, just not what they were in terms of some moderation. So then the cyclical index change went from 0.4 to 0.3. Now exports year over year for July, when you look at it, they were expected at 30.9, came in at 29.6. So exports were about right in line, but imports. So imports were expected at 44%. Came in at 38.2%. So remember, the slower the imports, it leads to a slowdown in exports. So especially for a country like South Korea. So that's where we're starting to see some of the pressure, where imports are moderating a bit, exports are going to slow down. Still, obviously, double-digit growth, but not to the level that it was as we continue to see some of this moderation. Now, South Korea PMI manufacturing was expected, last month was 53.9, came in at 53. But inflation's picking up. So CPI increased from 0% to 0.2%. And again, you're starting to see that inflationary pressure pick up in Asia, which again is going to make some of those imports that we're bringing in more expensive over time. So now when we turn to Japan. So Japan is a complete and utter mixed bag, which is, the fourth largest economy in the world, behind, U.S., China, Germany, and Japan. they go back and forth. But when you look at jobless rates, it was expected at 3%, came at 2.9, fairly flat. Industrial production was expected at 5%, came in at 6.2. Industrial production, retail sales was expected at 2.7, came in at 3.1%. But department store supermarket sales were expected at 0.5, came in at negative 2.2%. So again, some shifts in terms of where people are spending. So then we look at manufacturing was expected at 50, last month was 52.2, came in at 53. Vehicle sales slowed. Consumer confidence started to edge up a bit. Inflation was down a touch. So you're starting to see a little bit of a wake up in Japan. But again, the Olympics is there. What is the Olympics going to do? What is some of the stickiness in COVID as you get some of this expansion in lockdown? So Japan, to me, is kind of it goes sideways. I think South Korea slows a bit. Taiwan slows a bit. And then the Southeast Asian nations, Thailand, Indonesia, Malaysia, Vietnam, continued to struggle a bit under COVID and some of the issues on trade. So then when we look at Korea, this is just giving you an idea of the 20 days versus the full month. So when you look at where we were at the 20 days, you can see how the things moderated towards the end, which is what we've been seeing, this moderation that runs from June into July into August, that we see some of this moderation when we're considering what we expect just based on what July was, how July finished a little bit softer, and then August so far has seen that follow through. But then when we look at India sales, so this is something to consider when you're looking at the sales manager index, because India had the bounce, and now they're slowing again. And when you look at we have to look at what is declining, what is slowing. And when you look, it's fairly across the board. So business confidence is nearly flat. Growth index is rolling over a bit. Sales growth is indexed while price charge is increasing. Staffing levels are coming down again. That's employment. Profit margins are coming under pressure because when you're looking at it, you have growth moderating. You have prices charged going up. You have how much of that can you pass through? And if you can't, your profit index gets hit. So again, there's a lot of this pressure that is kind of this mix within India, which is where the gasoline got a little bit better, but now we're seeing a little bit of pressure in general. So again, India is going to improve, but it's not going to improve at the same rate and improved after it came out of their national lockdown, because there's other mitigating factors, not only internally, but also externally. So then when we turn a bit to China, so let's provide some important commentary on this. So when you look at the what Xi Jinping presided over a study session. So the study session was strengthening national defense and modernizing the army. So again, this has been a big deal for him and has been a signature policy. So what does he say? We must persist in strengthening the overall planning of war and make preparations for military struggle. A strong country must have a strong military. Only a strong military can ensure national security. In a separate article published, the party's leading theoretical journal, Xi said the absolute loyalty was the secret sauce to China's military modernization. We should do a good job in arming officers and soldiers with the thoughts of socialism with Chinese characteristics and ensure that the army is absolutely loyal, pure, and reliable. Remember, Xi has been very adamant on getting people that are loyal specifically to him. That's why the point of Chinese characteristics is such a pivotal comment, especially when you look at the pressure that's been coming with, freedom of navigation, not only just from the US, but now from the UK. There's more and more of this pressure mounting. As far as Xi is concerned, ideological loyalty is at least as important as modern weapons and tactics. Facing a more bellicose U.S. and increased political instability around its borders, China's military upgrade has taken on added urgency, especially when you consider what has happened between China and India, where they have just recently announced that they are going to decrease some of the individuals that are currently sitting along the border. So now when we turn to some of the data. So non-manufacturing PMI was expected at 53.3, came in at 53.3. Manufacturing PMI was expected at 50.8, came in at 50.4. Composite previously was 52.9, came in at 52.4. So again, seeing that slowdown. Now the Caixin China PMI manufacturing was expected at 51, came in at 50.3. Composite was at 53.1 because PMI services was expected at 50.5, came in at 54.9. Now that flies in the face with some of the local capacity that we've seen on the services side, which is but something that needs to be considered going forward. So what does that mean? So on Monday, international media outlets found a document that was issued by the Ministry of Finance and the Ministry of Industry and Information Technology back in May. So it was titled Document 551. So it contains guidelines, procurement guidelines for public hospitals, companies, and other state-owned entities. So it sets out local content requirements on 315 products. According to anonymous former U.S. official who obtained a copy of the catalog, products on the list include medical equipment, ground-based radar, testing machinery, optical instruments, items used for animal husbandry, marine and geological equipment, and the anonymous official said it violated China's commitment under the World Trade Organization and the U.S.-China Phase 1 trade deal. But to be clear, government local product procurement requirements have been on the books since 2002. So for decades, like this isn't new. In 2002, China's legislator mandated that government's funds should only buy foreign when domestic products were not available. In 2016, the State Council explicitly required public hospitals to prioritize procurement of domestic medical equipment. We'll need to see the document to assess, which we're starting to get pieces of. And the thing is, U.S.-China, this isn't going to help the U.S.-China relations. This will only hurt trade ties further, but it also speaks to, again, the dual circulation strategy, local consumption. So when you look at the PMI services, how much of that is really being influenced based on some of the local shifts as prices go up abroad and they're trying to localize because manufacturing remains weak, which again speaks to the slowdown on the export-import side. So they need to find a way to offset that, and the services is that natural way that they're going to try to do it. But when you look at overall policy, so this is where you start to get in and you pick apart, and the services side doesn't make much sense. So tightening policy is pushing housing prices back to trend. So now you get prices coming back down to trend. Housing sales growth is cooling into second half. So do you look at the consumer or the services side? What money are they using to buy stuff if you have wages that have been compressed, you have prices that have gone up but have been protected because they've tried to increase export prices, keeping local prices moderate, and now you have COVID coming up. So those service numbers, that PMI service number is going to come under a lot of pressure as we have more lockdowns. You have over 150 provinces that are either medium, 140 that are medium risk, 5 that are high risk, and there's no communication allowed. There's no travel allowed between them. Ride-sharing services have been suspended. So how much of that growth is going to happen as we come into August, which again continues to be a bigger problem, on top of the pressure that we see on residential prices and housing sales growth. So now let's talk about why I'm concerned about the economy going forward, because the government, the CCP, held a special meeting. When the CCP holds a special meeting, there's usually a problem. So the meeting's readout reflected rising concern about the economic outlook. At present, the global epidemic continues to evolve, the external environment is becoming more complex and severe, and the domestic economy recovery is still unstable and unbalanced. To counter that pressure, Beijing plans to lean more heavily on fiscal policy. Now, this is the panic moment. Does China panic, and do they stimulate where they've been pulling back on capacity? So, and if you read this specifically, they're going to rely on fiscal policy, because that's essentially telling you the PBOC said monetary policy is unavailable because we need to tighten because there's so much froth in the market, which is starting to ebb and cut down, which is creating that more reliance on fiscal. So the government wants to ensure the budgeted investment projects actually get underway, speed the issuance of special local government bonds, SPBs. Now remember, SPB was special purpose bonds were supposed to be cut, not increasing. So is this part of a little bit of that panic? The central government allocated 3.5 trillion renminbi for SPBs this year. But as of the end of June, local governments have issued only 1.01 trillion renminbi SPBs, a mere 27% of the annual quota. Why is that? Because they're being forced to cut leverage. So you have a panic where they're essentially, the provinces and the local areas are looking at this and saying, I have no project to invest this in, but I'm paying the other SPBs with tax revenue because they're not yielding anything. So how can I invest in projects that were weak already and I can't? So this is where are they going to be forced to? While Beijing looks set to ramp fiscal spending, they are going to hold the line on monetary policy, will remain prudent and focused on ensuring that liquidity is properly ample but not exaggerated. The readout also pointedly stated that the government will strengthen the autonomy of our monetary policy. Clear indication that they're not going to be looking into it. So the government is worried about the outlook for a second half, which means investors should be as well. The clear indication that authorities won't let the actions of other central banks disrupt efforts when you think about the Fed. So again, you're starting to see these pressure points. So this is how I've said from since last year that China was lying and that there was a surge and it was going to ebb quickly. And here's just an example of additional slowdowns that have been coming. When you look at new export orders in China manufacturing PMI are negative. They are contracting. Manufacturing new orders under the Caixin market China manufacturing PMI are negative. They're contracting. Again, the export side is slowing. This is a mixture of companies shifting away from China, but as well as just a certain amount of saturation as they're waiting on new capacity to come out, which again is leading to some of these slowdowns. So now when you think about that, you have to consider what has happened. So they had another meeting where the CCP invites against other political parties. There's 8 in total in China to come offer advice and feedback. So the most interesting comments were from Li Yi, chair of the Department of Public Finance at Peking University School of Economics. Liu proposed to get domestic consumption humming by, and so again, domestic consumption, dual circulation strategy, local procurement. Again, this is the driving force, consumption. They need to drive consumption because that's where the biggest problem resides. Improving the quality of consumption statistics and incorporating virtual and service consumption into overall retail sales statistics. So trying to boost the number by just adding more stuff and adding that component. So again, trying to move the needle to make it look better versus historics. Allowing local governments to keep a larger share of consumption tax revenue. Again, that would incentivize it because the bigger the consumption tax revenue, the more the local government has to spend. Increasing investment in the development of the digital economy. Now, the second one is key because if cash-strapped local governments get to keep more of the tax receipts, they'd be more incentivized to drive up local consumption. So again, his whole view was trying to align tax receipts with where the target is for where the CCP wants, while also including all of these other statistics. So what is the underlying problem now with some of the areas that are seeing pressure? So Henan officials are on the hot seat. So Henan updated, the state council announced it had set up a team to investigate the disaster because if you look at all of the issues, so the whole province has been washed away. There's been hundreds of deaths. The infrastructure is washed away. Industry's been destroyed. So now the state council announced that it set up a team to investigate the disaster and evaluate local authorities' responses. So they're essentially going to blame local authorities. To summarize disaster response experience and lessons and propose improvements to disaster prevention and mitigation measures, hold authorities accountable for for failure of duty in accordance with laws and regulations. So the problem is this was a once in a lifetime, once in a 1,000 year flood, because they got their yearly rainfall in 2 days. Again, it's hard to protect against something like that when you're not your infrastructure isn't built for it. But most climate models, again, continue to predict these extremes. When we talk about extreme floods, extreme droughts, this is just one of those other examples. So then when we look at output prices, so that when you look at, according to IHS market demand was sensitive to product prices, which limited enterprises' pricing power. Output prices have stalled because, remember, they've been trying to hold back because PPI is still increasing. China's trying to hold back these prices to try to keep that consumption moving, trying to keep that consumer side growing. So Chinese equity markets in U.S. terms versus total social financing, you get an idea of where total social financing is. So when you look at the index in general, that financing continues to move down, which again is going to put more pressure on some of that equity markets. And then when we look at the liquidity indicator, so when you look at LONGVIEW commercial bank liquidity, so the LONGVIEW is obviously the company doing this, the liquidity, they flatlined it. So they're trying to keep it there. So the financing is going to continue to come under pressure as the liquidity is pulled out. And you can see they typically lead. So when we look at some of this liquidity indicator coming down, that's again going to pull down some of this availability. So when you look at monetary versus fiscal response, they're essentially the PBOC is essentially saying, I've got nothing. You need to do this on the fiscal side. We need to keep getting some of this excess capital out because we're so far over our skis. We're continuing to see off-balance sheet risk. So this is, again, the moderation that we keep seeing. Now, when we look at China, this again speaking to the junk side. So Asia junk debt hits new lows as U.S. high yield marches higher. And this is that bifurcation with the risk that is continuing to crop up with a lot of this Chinese debt, making it difficult to roll, putting more pressure on the underlying government, the underlying economy. So construction activities slow further. So when we look at land transfer, again, remember they keep coming after housing and building. So construction activities slow again. So when we look at residential floor space being started, the trend continues lower. And then when you look at excavator sales continuing to move down, real estate investments in construction installment, all of this points to additional slowdowns, which is, again, speaking to what is the total goal for economic growth, which continues to be hindered. So now rounding it out, when you look at consumption, when you look at the driving force of what they're trying to accomplish, rural wages, agriculture, and non-agriculture in India continue to get worse. So when you think about China, you think about what has happened there so far, then you look at what's happened in India. They're facing similar issues and the wages continue to deteriorate. So it's going to be hard to see Indian services continue to grind higher when you look at rural wages. Now look at non-rural. Let's look at industrial salary survey. Expectations for net quarter continue to get depressed. So not only is the US and Europe and China seeing wage compression, India is seeing the same thing. And again, this is why it's not just a China problem. It's not just a US problem. It's a global problem where wages are just not keeping up with this increase in pricing, which again continues to be the overhang. So if you have any questions, you know where to find me. You can find me on Twitter. You can find me on through email or obviously through the questions and comments on YouTube. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.